Hi, everyone. For those of us joining, we'll just wait a few more minutes, and in about 2 minutes, we'll go ahead with the event. Hi, everyone. For those of us joining. Okay, I think we can get started. Hi, everyone. Welcome. Thank you, everyone, for joining today. My name is Sanctions. I work at the Jane Family Institute, and I'm one of the editors of Phenomenal World. I'm really glad to welcome you all and introduce this discussion today on economic war and the commodity shock, initiated and organized by Alex Yablon, who I'll pass it over to in just a moment. We're really glad to host this conversation today with Nicholas Mulder and Javier Blas, who've both authored extremely relevant books on the topic, for which we'll be posting in the chat links to purchase from the publisher along with discount codes. Just a little bit more information. Phenomenal World is a publication across political economy and finance, and we also have a weekly newsletter, PW Sources, that compiles reading across the social sciences. We'll be posting the sign-up link also here, and that's where you can learn more about upcoming events like this one. And just right before we start, a few housekeeping notes. We're really excited to say that this is our first true hybrid event. Javier is in London, Nicholas is in Ithaca, and Alex and many guests are here with me in the JFI office in Manhattan. So bear with us if there are some, differences between being in the conference room and being also online. And so after 45 minutes of discussion, the panelists will begin to answer questions. So please use the webinar's Q&A function to ask questions as we go along. And for those in the JFI office, we'll bring us onto the video stream so you can ask questions as well in that format. Also note that the session is being recorded and we'll be posting it on YouTube. So yeah. And with that, I'll pass it on to Alex, who will go ahead and kick things off.
Thanks so much, Sanoja. So yeah, I just have a little introduction here. So the war in Ukraine has unleashed not just geopolitical, but economic strife. And nowhere is that clearer than in the extreme volatility in commodity prices, which have fluctuated wildly since the invasion began. And a wide coalition led by the United States retaliated with harsh sanctions on Russia's financial system and trade. Few outside the American intelligence community expect Russia to invade, and even fewer expected Russia's rivals to so forcefully and swiftly confront the belligerent power with such a wide raft of economic sanctions. Even though the diplomatic relations with Russia have been deteriorating for more than a decade, the Western attempt to cut off economic relations with the country may be an historical turning point. For the first time in decades, the world finds itself in an economic crisis originating not with the financial sector, but the real economy. The economic disruptions of war itself and the breakdown of the longstanding financial and trade ties with Russia, the global commodities powerhouse, have had repercussions across the world. Rising fertilizer prices threaten the viability of farming as far away as Peru. The loss of Ukrainian neon production drives up costs for Taiwanese chip manufacturers. The blockade of the port of Odessa threatens a food crisis for the Middle East and North Africa. And the financial exchanges where metals like nickel are traded threaten to break down as pricing chaos pushes margin calls ever higher. So to shed light on the confrontation between the West and Russia and how it may reorder the global economy, we're joined by Cornell historian Nicholas Mulder and Bloomberg columnist Javier Blas. Professor Mulder is the author of The Economic Weapon, The Rise of Sanctions as a Tool of Modern War. In this volume from Yale University Press, Professor Mulder charts the rise of economic sanctions as a coercive geopolitical tool from World War I through the end of World War II. As Mulder's book demonstrates, sanctions have enormous destructive power and should be understood as weapons of war rather than alternatives to war. But they have a decidedly mixed track record when it comes to their actual strategic efficacy. As The Economic Weapon shows, rather than tempering belligerence, the specter of economic coercion can in fact push revisionist powers to greater extremes. Javier Blas is an opinion columnist for Bloomberg covering energy and commodities. Last year, he and reporting partner Jack Farchi published The World for Sale, Money, Power, and the Traders Who Barter the Earth's Resources with Oxford University Press. The book charts the birth of the modern global commodities market in the post-World War II era. The World for Sale takes readers inside the often shadowy field of commodities traders who have made fortunes by taking enormous risks in moments of political upheaval, much like the one we face now, often with little regard for the political or moral consequences of their business. So with that, I'd like to start with a question for Javier. Can you just sort of this shock that we're experiencing right now doesn't it came at a moment of stress for global commodities markets as it was. So can you just sort of set the context for before the war broke out and sanctions were being imposed?
Well, thank you so much for having us, Alex, and I really appreciate for that introduction. You are absolutely right. The commodity market was already going through a period of stress before Russia invaded Ukraine, and for several reasons. One is because investment in new production capacity have come down significantly over the last few years. Prices were lower, so financiers left the sector. They were not making much money. And then also there was the pressure from climate change and trying to reduce our reliance on fossil fuels. So all of that have combined to tighten the markets. Demand was recovering very strongly after the impact on the kind of the 2 years of COVID-19. The supply was not rising at the same pace. And we were having already pretty high prices across a spectrum of commodities, from copper in metals to crude oil in energy, and coal in particular in energy, to corn in the agricultural market. So the landscape before the war was one of already an ongoing tightness. And I will have expected prices in 2022 to be higher than in 2021. Even if the war have not started. Obviously, the war has been massively disrupted for the commodity industry, let alone in terms of human life in Ukraine. And that has really tightened the market beyond what anyone have expected. And here we are with, the cost of oil at $100, the cost of agricultural commodities in many cases reaching an all-time high, and metals not only trading an all-time high, but in some cases levels that almost are incredible. You have asked me if we will ever see the price of nickel at $100,000. I will have said absolutely not, and that happened only a few weeks ago. The previous peak was more than about $50,000, so that was more than double. That's how incredible prices have been. So that's the context. It was a market that was already tight and tightening, and then the war hit.
And then, Nick, can you just sort of give us the lay of the land of the actual sanctions, and what sanctions have we actually seen, and what's the relationship between the actual economic countermeasures that the West has imposed and then the self-sanctioning and the sort of fear that's spread to financial markets, and in particular commodity markets?
Yes, well, first off, thanks very much to the Jane Family Institute and to you, Alex and Sonoja, and also to Javier for being on this panel. I think the JFI has really been putting out some of the best material on these issues of political economy, so it's a real pleasure to be on the panel. On the sanctions, I think the main things that we've seen were a dramatic ratcheting up of existing pressure, because there were, of course, already sanctions on Russia since 2014, but they hadn't really had a major effect on markets. Just as an indication, last year in April, the US Treasury put sanctions on Russian sovereign debts, and it caused a little ripple for about a day or so in Russian government bonds, but after that very quickly subsided. And there had been a conscious effort since December already to build up the prospect of a very severe sanctions package as the Russian military buildup was happening, right? And the aim was here to deter Russia, to raise the cost of them undertaking any sort of action. Some of those sanctions kicked in when 2 days before the invasion, Putin recognized the Donetsk and Luhansk People's Republics. So that was the first financial sanctions were tightened then. But since then, we've seen really a torrent of sanctions in a number of packages. The EU is now already onto its fifth package. And these really went for sectors that hitherto hadn't really been affected by sanctions against Russia. They also have cumulatively really added pressure. So the swift decoupling was announced first for a number of financial institutions. That list has now grown. New institutions have recently been added to it. So that's progressively blocking every Russian financial institution from access to the SWIFT international telecommunications network. There's also, of course, a number of foreign investment bans. I think we haven't talked about those, but there were already existing sanctions that limited Western investment in, for example, Russian oil and gas. Those have now been dramatically tightened, and it's now become very, very difficult for any new foreign direct investment or portfolio investment in Russian equities and in Russian enterprises to take place. Of course, another major sanction that we've seen is a very wide-ranging export ban on sensitive high-tech components to Russia. That had already, in a very subtle way, aspects of that had been pioneered against China by the Trump administration in 2018, 2019, but only against discrete companies. It had never been really used against the nation as a whole. That's also, I think, been a major new measure, the effects of which we're still waiting to see, but they're definitely going to be pretty significant. And then finally, I think the sanction that really many of us have seen as the most dramatic one was the freezing of a large part of the assets of the Russian central bank. And that now, of course, has brought back this question of the future of dollar hegemony. It's also created all sorts of issues and raised questions about where Russia will accumulate earnings from. And it's, I think, now focused minds also on potential embargoes against the remaining Russian exports of commodities, precisely now that a large part of the accumulated earnings of hydrocarbon exports over the last few years have been frozen. There is, of course, still in this high price environment, like Javier described, there are still exports going on. So I think it's logical that now we're all looking at the very large daily and weekly revenue that those exports are bringing in. And I think that's really where the discussion about future sanctions now in the next few days and weeks is going to focus on.
Yeah, I guess sort of building on that, could you just sort of, what are you looking out for in the next few days and weeks? And in particular, what you just described as a set of sanctions on the Russian financial system, and then exports to Russia of sort of high tech components. So I guess there are two things. Why then has the rest of the world experienced the blowback from this in terms of rising raw materials costs, if those have not actually yet been sanctioned? And then what should we prepare for as those actual raw materials that, really drive the Russian economy do come under sanctions?
Yeah, that's important, I think, to go into. I would distinguish two particular tendencies or trends. One was already in the weeks leading up to the invasion, as this military buildup was reaching a kind of critical force. You could already see in anticipation a number of prices of commodities going up. And there were even people, right, speculating that this was maybe part of the plan, that the military buildup was a way of actually raising the price of Russia's most valuable exports. Of course, militarily heavily armed petrostates have this Munchausen-like power to raise the price of their own vital exports. So there's a kind of perverse logic potentially at work there. That was one tendency. I think the reason, however, that we're having this discussion and why the sanctions against Russia have become an incredible global macroeconomic event is that these measures that I just described were not the only things that had an effect. They, because of the speed with which they were imposed, triggered a major reaction by the global corporate sector. This went hand in hand, of course, with also widespread moral outrage and PR concerns over continuing to do business with Russia as it's waging this war of aggression in Ukraine. But I think a large part of it, right, some of these companies ordinarily weren't really troubled by doing business in Russia. There were already human rights concerns and all sorts of concerns. So I think actually one of the explanations for this is also that there's clearly a fear of future sanctions, a kind of overcompliance fear. And that, I think, has been really the thing that has pushed up commodity prices massively. So once you no longer have shipping, right, Ukraine is in this acute situation that, like you mentioned, Odessa's blockaded, and the war is the direct cause of Ukraine not being able to export. In Russia, it's not so much military factors as the global corporate backlash against the Russian economy, the exodus from it, and the fact that insurance, shipping, all of these things are now much more difficult to arrange. That's, I think, now also interestingly starting to seep into the further measures, because, for example, the EU, in its package that it announced earlier this week, included transport and shipping. And immediately you could see small European member states like Malta, Cyprus, and Greece, which have very large merchant marines, pushing already for carve-outs and exemptions. So in Europe, there's now really a point that's been reached where all the relatively painless sanctions have been imposed. And now you start to see a pretty acute and heated political argument emerge over burden sharing. And we can go more into that. I think that raises important macroeconomic questions, but that is now, I think, where we are. And going forward, I think there's no painless options left, and it's really going to be a question of who takes the burden. And I think the different sectors will hit different countries in that regard.
Yeah. And you talked a bunch about reputational risk and sort of like moral outrage. Javier, are those the kinds of things that normally weigh very heavily on commodity producers? I don't get the sense from your book that they do.
No, you're right. I mean, usually commodity traders, they put morals to one side and they describe themselves apolitical. The same commodity traders that they were happy to deal with, say, a right-wing regime in Latin America, like Pinochet in Chile, they were doing business at the same time with Fidel Castro in Cuba. So they didn't care about the politics, they only cared about money. But what is happening now for some of these traders is that they rely on banking finance. And the banks do care about where you are doing business because they have shareholders. So that is the point of pressure. But we are seeing that at the moment, the oil and gas and coal are still flowing out of Russia. Some of the agricultural commodities are still flowing, with more difficult because of shipping restrictions. Metals is flowing out of Russia. And the world until now has been buying because, as Nicholas explained, the perverse effect is that by ratcheting military campaigns, Russia can actually push up the price of the commodities that it's using to finance those military campaigns. But back of the envelope calculation is every day the world is paying Russia roughly about $1 billion a day for his natural resources. The bulk of that is coming from oil and gas, with a bit of additional on coal and metals and agricultural commodities. And a lot of that is transported, shipped, logistical considerations and financed by the commodity traders who are happy to continue doing business with Russia. And as long as it's legal and remains legal, they will do it because they will put morals aside. And the justification that they will give is, well, we are here to provide business and we are supplying the products that are on demand. So if the world wants to stop demanding those products, we are happy to stop supplying them.
Right. And I mean, not just they're continuing to flow, but you tweeted last week that gas flows are at an all-time high, right?
Yeah, I mean, it's not that they are continuing. In some cases, and the gas market in particular, we have seen is that the flows of Russian gas to Europe, and ironically, those flows through Ukraine, through the big three pipelines, gas pipelines that connect Russia to Europe via Ukraine, have been rising over the last few weeks, and certainly they hit, as you said, a 4-month high earlier this week. The reason is how the complex world, how long-term contracts for gas work. But there is an incentive if you are a European utility to buy today and maximize your volumes from Gazprom, because that's cheaper than to buy on the spot market. So then everyone is trying to maximize that and make money, which is very sad. But that's how some of these companies behave, even in these situations.
So I guess, could you talk, both of you, is there precedent for such a diplomatic effort to isolate and coerce, not just a producer of oil, but a producer of basically every major commodity? Russia is the largest commodity exporter in the world. What does it mean that it's so central to the world supplies of so many different raw materials, and that we're trying to sort of cut it out of the world economy?
I can start with the commodity question if you want, and then Nicholas can go more into the sanctions regime. But we have seen examples in the past where we have tried to driven exports of a particular country to almost zero, preventing that country from exporting his oil. I mean, Iran is an example, but we have perhaps even a better example is Iraq after the invasion of Kuwait in 1990, where the United Nations imposed an embargo on Iraqi oil, which actually stayed in place for many, many years after the war ended. But Iraq was effectively a supplier only of oil. The problem is Russia is a superpower of multiple commodities. It's one of the world's largest producers of commodities ranging from oil to gas to aluminum to wheat and many other dozens. I mean, there are very few things in the world that they are made out of natural resources where you could be sure that you pick it up and say, no, this piece of hardware that I have on my hands have no commodities from Russia. I will say that very, very few things that you could just pick it up and with confidence say there is nothing Russian here, because Russia produces so many commodities, just not one sector. And in so many cases are commodities that they are taken for granted because they don't play a massive role into the global economy like oil. But when they are disrupted and you face a scarcity of them, then you realize that actually they play a massive role on this very little sector, which have massive repercussions later for the global economy. Neon and chips is one example, but I could think about titanium. Russia is one of the world's largest producers of titanium, and this metal is a super strong metal, very light. It's used on alloys for the aerospace industry. The manufacturers of airplanes, Boeing and Airbus, are going to have trouble with titanium shortages if we impose sanctions on that. So it's just the size of Russia in the global market what makes the sanctions that we are putting, or we are starting to consider on commodities, very remarkable and having a huge macroeconomic impact.
Yeah, and I can add a little bit on the difficulties of embargoes against commodities. It's also worth maybe first saying that there is a big difference between trying to prevent countries from importing crucial commodities, because we have more historical experience trying to sever the imports of commodities going into countries than we have experience with trying to prevent exports of commodities. So if you think about crucial commodity cutoffs, there's many interwar examples, some of which I study in the book, but also in the Cold War period, you can think about embargoes against states like Rhodesia and South Africa. They actually were also commodity exporters, but mainly of metals, but they were all poor in oil particularly. So oil was always a crucial commodity, and there was a big international effort, right? Many years, of course, much of the commodity trading industry also tried to find ways of getting around it very ingeniously. But cutting off imports of crucial commodities is really where there's a lot of international, both at the level of national states, but also at the United Nations experience with. It's only really since Iraq in the 90s, which led to the oil for food program, and then more recently Iran and Venezuela, that we've tried to start reducing commodity exports of countries to zero. And generally speaking, it seems so far that it's more difficult to do the latter, to restrict the exports, than to sever the imports. Both of them have their issues. They both have leakage. But one of the main issues is that in order to stop commodity exports from occurring, you really need to be able to close off all the potential markets that they might be able to go to. And in a world economy that's as complex as ours, there are many ways of intermediating these trades. Even Iran recently, right, despite the maximum pressure campaign, which was incredibly aggressive on trying to reduce Iranian oil exports, the UAE, Malaysia have still been very important conduits for Iranian oil exports to China. There has been even very small scale, hundreds and thousands of dirt motorbikes in Balochistan, bringing oil across the border into Pakistan, where it can be sold at an incredible premium on street markets. So these things, you don't think that they matter, but there's many, many ways of getting around them. We still have to really see what the long run effect can be on these oil export embargoes as a strategic weapon. The one thing that does seem to really inflict really severe damage, and that's Venezuela is a good case of that, is trying to restrict foreign investments in countries that have an oil or commodity sector that really depends on foreign technology, severing the access of those foreign enterprises to those markets. In the case of Venezuela, right, it's led to an enormous collapse in their oil production, and that has had the result of reducing their GDP by, I think, 3/4 of what it was in 2013. So I think those are some of the issues that we're dealing with now. And then, of course, in Russia, the question is, right, how can you do that not just for oil and gas, but against potentially all these other things? And is that even possible? Are there substitutes available? And is there sort of a fungibility of resources in our global supply chain? I've read, for example, that palladium can be replaced with with platinum. So we can make catalytic converters out of platinum, but it takes more time, and we'll have to figure out how to do that and see if we can do that for the entire global car industry. So it's a big challenge.
Yeah, I've struck a few times you've said in interviews and stuff you've written, Nick, that you are concerned that this could be the first sanctions-induced. We could be on the verge of the first sanctions-induced global recession. Can you just talk a little bit more about that and what raises that specter for you?
Yeah, definitely. I mean, again, right, that's not a certainty, and there's a lot that we can do to avert it, and I hope that is done. And I would say that that really, the fact that there is a risk of this means that we need to think very proactively about globally coordinated macro policies. And concretely, I'm thinking about supply side investment in the advanced countries that have already had quite a lot of stimulus and where incomes are not the problem, incomes are relatively buffered, and income side support policies for the developing world and the global south, because for them, the higher prices of commodity imports really eat into the welfare and the well-being of people. But I think that the risk is due to the complex of factors that Javier described at the beginning, right? That we've imposed sanctions not in an already very smoothly, copiously supplied world economy. And we were forced by the Russian invasion to start using sanctions in a moment of incredible tightness in the markets. And not only that, we've also been forced to do so relatively shortly after the recovery from the COVID recession. So the supply chain issues that's left in its wake, the war, the sanctions, the overcompliance effect by the global corporate sector, climate-related disruption, right, which is increasing every year. That's a fifth factor. And I would even say as a sixth factor, a sort of prospective, anticipatory, some people call it the return of geoeconomics or the return of geopolitics, but that's having market effects as well, right? I think if you think about the enormous amounts of wheat that China is stockpiling every year, this also began when Trump was waging his tariff war against China. So there's all these legacy effects of the last few years that have built up, and then to launch sanctions into that, the war in many ways necessitated some kind of economic response, but these are really far from ideal circumstances from a global macroeconomic stability standpoint to be using sanctions in, let alone at this size. So I think that's really the risk. And then a final thing is global financial the global financial conjuncture, right? We're in a hiking point in the global financial cycle where there's already a flow back out of emerging markets back into the core of the world credit system, the dollar-based system. So that was already an issue in terms of the rising debt servicing costs for much of the global south. Add to that the heightened price of importing now commodities that are much more expensive, food, energy, etc. And I think that there's a really pretty serious chance that certainly in Asia and Europe, much of global growth will be eroded this year by the effects of this. The US is maybe in a slightly better position, but the question is how long it can hold on. And even in the US, there's the risk of a hard landing. I was at a meeting earlier this week with some economists where one of them actually said that they estimate the chance of a hard landing in the US also being something like 35 to 40%, simply because inflation expectations have gotten so out of kilter. So I think that's the kind of complex. If there's no certainty, but there's a serious risk, and I think we need to think proactively about how we could forestall the possibility of that happening.
Yeah, and Javier, I guess one of the sort of the sort of freakier manifestations of this this crisis, that which you alluded to earlier, is for instance, the nickel crisis of a couple of weeks ago. And could you explain why this crisis has put so much stress on commodity exchanges and the financial side of commodity production and commodity traders? And why should that matter for the rest of us? What are the economic consequences if some of these traders can't make their margin calls, if exchanges continue to freeze up?
That is a very, very important subject right now with all what's happening in Russia, because all of a sudden what we have seen is this rapid shock to the system, and certainly some commodity buyers and commodity traders got surprised that actually Putin invaded Ukraine. They were not expecting that. So what has happened, and we can use the example of nickel to explain the situation. Nickel was a market that it was slightly on a deficit, but the expectation perhaps that this year was going to be on surplus, and a big Chinese privately owned company led by a Chinese metal tycoon, which is popularly known in commodity markets as Big Shot, decided that he was going to go short on nickel. Effectively, that's commodities speak, to bet that the price was going to go down. Obviously, he was not expecting Putin to invade Ukraine, and Russia is a big producer of nickel. Immediately the market thought, worst case scenario, we lose access to the nickel supply of Russia, so the price started to going up. And this gentleman was short. So it was on the wrong side of the market. When you buy or sell a financial commodity product like a future on the exchange, like the London Metal Exchange, you don't have to pay for the whole thing. You just pay a fee, an initiation margin, as it's called, and then your broker buys on your behalf the full position. But sometimes you pay something like 5 or 10% of the price, and depending on where the price goes, you pay a bit more every day, which is called the variation margin or the margin call. If the market moves against you, you pay a bit more margin. If the market goes in your favor, you get a bit more or money from your broker. As the market started to go up and up and up, the Chinese position was underwater, and the brokers were demanding more and more money from this position, which at one point forced the short position to start buying back his position. So you have to buy futures. When the whole market got into that situation, we got what we call a short squeeze, which forced everyone who was betting on the downside to buy back those positions because they are facing billions of dollars of margin calls. And that is a loop, as a catch-22 situation. The more they buy, the more margin calls they face. And the more they buy, the more margin calls they face. And it got to a point where the market went up 250% in about 36 hours. The margin calls were on the billions of dollars. And the exchange have no option but to shut down trading, which is a very, very unusual situation that happens once every few decades, that a major commodity market has to shut down. And not only that, they cancel a bunch of trades that have happened for a few hours, because the margin calls of those trades were risking bringing down not only a few brokers, but perhaps the whole exchange. And the fear on the market is that what if this happened, not on a market that is important for a few industrial users like the nickel market, but for the global economy, it doesn't really move the needle. But what if a similar situation was to happen on a market that really matters, like oil or wheat or gas? And what kind of consequences for the global economy? And it's when we have started writing about and discussing something that we did in 2007, 2008, 9, during the global financial crisis. And is, as we refer to the banks as these too big to fail entities, that the Fed could not let them collapse because it will bring chaos on the global economy. Are the commodity traders, are the commodity exchanges also too big to fail, because the failure will bring chaos to the global economy on a different way? It will not be through the credit channel, but it will be through the real economy. Perhaps shortages of commodities, or perhaps such a high prices for critical commodities that were crippling the economy. So this is what we have been doing for the last 6-7 weeks, which have been very intense, and a lot of veterans on the commodity markets, people who have been trading, buying and selling commodities for 40 years, they say that they have never experienced anything like this.
Yeah, I guess stepping back, how did we get a global market in so many commodities? I was struck in your book that it's not like this has been around forever. This is something that developed in a sort of particular geopolitical circumstance, geopolitical context. I guess, could you talk about the geopolitical context for the creation of global commodities markets, and then how the possibility of the disruptions from this and the possible long-term realignments that we might see because of this war, how that might change how the globe sources its stuff?
Well, it's very interesting. When Jack and I were writing the War for Sale, our book, we thought where we start the story. What is our entry point? And you think about commodity markets. Well, your entry point will be really the dawn of mankind, and when we started trading stones and the first few metals and maybe some seeds for other seeds, etc., etc. But when we look at the modern commodity markets, we really like to think about the last 75 years, particularly since the end of the Second World War, and that's where our story effectively starts. And the main reason for that is that the current structure of the market is very much the result of the forces that came after the Second World War, and oil in particular, which is the great commodity market, is even more recent. I mean, all the way until the mid-70s, oil was a vertical industry where Exxon will produce oil on Exxon wells to be refined on Exxon or ExxonMobil refineries to be sold on Exxon-owned petrol stations, we call it here in England, gas stations in America. And it was a vertical integration, and that market really broke apart with the wave of nationalizations of the 60s and 70s, particularly the nationalization of the Middle East oil industry. And all of a sudden, a bunch of different countries, petrostates in the Middle East, North Africa, West Africa, have oil to sell. For the first time, they were responsible to sell it themselves because they didn't have the foreign investors. They have nationalized the foreign investors, and they call the commodity traders to buy and sell on the spot this new freely tradable oil. And that was really the birth of the modern industry as we know it like today. And that is why we say on our book that the commodity traders perhaps enable the birth of one of the most powerful actors of global geopolitics, which is the petrostate. Countries like Saudi Arabia, Kuwait, Iran, Iraq owe a lot to the commodity traders of the 70s, the power that they won later, because they were the ones who allowed them to nationalize their oil industries and take that first step.
Yeah, I thought that was really fascinating. I also wondered, if this current moment of disruption of these supplies and sort of unpredictable prices might push sort of the structure of these markets in a different direction. I was, one of the most interesting stories I saw recently was about how Tesla managed to kind of escape this nickel crisis because it had a much more integrated supply chain for these vital metals. And I wonder if you think that there could be more of a pressure for, big firms to pursue more vertical integration if these kinds of stresses persist.
I think that could be a very, very well one of the outcomes. I think that generally we are going to see the industry in general over the last few years have got accustomed at this kind of globalization wave, which has been on kind of the receding for the last few years. I don't think that it starts now. It just has been a few years on the making. But all these trends of just in time, having just enough inventories for only a few days. I think that that's going to change with the war in Russia, and everyone is going to try to hold more stocks or perhaps go all the way down to vertical integration. The other thing that we may see is that the commodity traders have been a sector which has been opaque, it's privately owned in general, so it's only a few families, a few individuals who own these companies. They are not listed on the market, so they don't need to disclose as much information. Some companies don't disclose anything whatsoever about them. They don't even say how much money they make every year or who owns the companies. And I think that policymakers have already kind of waken up to this industry that was very large, hidden in plain sight in many ways, and completely unregulated. And I just have the perception that policymakers are going to want to, if not regulation, at least have a better understanding and a better oversight of what's going on with the commodity traders. I don't think that we get out of this crisis and policymakers say, oh, yes, that's fine. We have all these companies that we don't know anything about them. We don't know who owns them or what money they make and how they make it, but that's all fine. I think that this is the time where policymakers wake up and say, hello, no, actually, we really need, at the very least, to understand the industry better. And I will be surprised if there's no more regulation coming.
Okay. And Nick, something you talk a lot about in your book is, especially in the run up to World War II, how the specter of sanctions, it provoked a reaction on the part of revisionist powers like Germany and Italy and Japan to sort of seek resource autarky. I'm struck by, in this context, how, Russia is in a very different position. They have the resources. How does the fact that Russia, it faces a lot of severe economic consequences as a result of these sanctions, but one thing it doesn't have to worry about is access to raw materials, and it's the sanctioners now who, they're the importers. Is the situation that you describe in the end of your book kind of reversed?
Yeah, that's a great observation. I definitely think that that's one optimistic factor where we might be able to see also the escalation risk being somewhat lower than it was in the 1930s, because indeed Russia doesn't lack any of these crucial commodities. It exports all of them. I do think it raises other questions, right, about how we're going to share commodities that are produced by alternate sources of supply. So I think that there's useful similarities to be drawn between the 30s and now. I would say, however, that there is one big difference, which is that the 30s, in the wake of the Depression, were a period of global deflation. It was a massive demand-side shock. We had an artificial demand-side shock in the COVID pandemic, but since actually we've had mainly supply-side issues. So in that sense, and the result of that is inflation, not deflation. So in that sense, we're in a different macroeconomic environment. And to my mind, the challenge now is indeed, another way of thinking about it would be to say, you have 37 or so industrial democracies in the North Atlantic and in Asia that have imposed pretty severe sanctions against one of the world's largest emerging markets. And what does that mean for the countries that are not in either of those categories, right? The remaining emerging markets, as well as the global South, and which includes most developing economies. I think one of the things that is important to keep in mind is that even if we're going to proceed with this oil and gas embargo, for example, in Europe, that has further global macro implications. And it's, people are now, of course, pointing out that there's only a limited amount of LNG available. There's going to be a bidding war. Everything that Europe is not getting in terms of gas through pipelines from Russia will have to come through ships at some LNG terminal. And it's directly competing, especially with Asia, which moved much earlier already to LNG imports. So to my mind, that calls, or that points to the need for some sort of global gas consumption quota system. I think, right, the temptation is to use very powerful interest rate hikes to try and actually increase some demand destruction or lower demand so that the price can also be brought down. I think right now that demand should be organized through diplomacy rather than destroyed through interest rate hikes. And that's a challenge, but you could think of it basically in terms of sort of the reverse of the exporters conundrum. What we don't need is necessarily only OPEC action, although it would probably be useful to bring the oil price down or stabilize it. But we actually need a kind of OPEC for gas consumption rather than for production as well, so that we don't have this kind of bidding war and keep global price pressures manageable. It's really managing an inflationary environment, not dealing with the consequences of deflation. So that's, I think, a major and important difference. But we do have more tools available than in the 1930s, when this was also very much bound up with just the basic legitimacy of government intervention to lift countries out of recessions. I think right now the issue is really burden sharing.
Yeah. So with that, I think it's time to open it up to questions. For folks who are attending the seminar on Zoom, we've got a couple questions submitted through the Q&A channel. If other folks want to put them in now. We also have some people watching from the JFI offices here in New York. So I don't know if we want to turn on you can turn on the conference room camera there. If any of the folks there in person want to ask some questions, you can just go ahead and raise your hand, and we'll unmute. But let's start with one from the Zoom Q&A channel. So Natalie Leonard asks, so how should we think about the quick recovery of the ruble and the Russian export recovery in the context of sanctions? I think that, you Nick, I saw you tweet some funny memes about this earlier.
Sure, I'm happy to just respond briefly to that, which is that definitely, right, this is a thing that we've all been looking at, because it was kind of part of the original messaging also, that the freezing of the reserves is going to reduce this Bank of Russia's ability to intervene to hold the currency up. But now I think you have a combination of incredibly tight capital controls, this forced FX transfer system from exporters to the central bank, and much more control. On the one hand, of course, it's totally true, right, that there's a deep degree of artifice to that. So this does not at all mean that the Russian economy is out of the danger zone. Quite the contrary, a lot of these effects of the technology export bans are only now beginning to really bite. But that being said, many countries under sanctions have always done this. So this is, in a sense, just par for the course. This is a natural, in a way, response of countries, even Sudan, for example, long under sanctions from the late 80s, to 2016, 2017, countries even of the economic development level of Sudan have resulted to pretty intricate parallel banking systems and dual currency systems. Iran has long had a multi-tiered currency exchange system where it allocates currency at different exchange rates for various crucial imports in its economy. So I think that this is simply a kind of survival reaction. The recovery of the ruble, right, shows that you can build up some resilience. It's limited in a way of it's a limited thing with which to ward off future problems, but it does mean, yeah, that you can stabilize the immediate shock. And definitely, if the hope was, it was probably an excessive hope that this was going to lead immediately to some sort of change in course, then that is something I think that we can now see it's going to take longer if there are going to be any effects.
If I may add, I think that there perhaps the biggest mistake of Western policymakers was to use the ruble as a kind of signaling of the success of the policy, because as Nick is rightly pointed, I mean, we have seen in the past that the moment that you go very hard with capital controls, and let's not forget, Russia is a country which enjoys naturally well, not naturally, but because of his position on the commodity markets, traditionally has a current account surplus. It's relatively easy for the central bank of Russia and the Kremlin just to engineer a strength of the ruble, and it kind of has backfired, because the White House and the European Commission, the same thing here in the UK with Downing Street, they used this collapse of the ruble on the first few days of the war as well. Here, our measures are working, and now a month later, the Kremlin is kind of using the same tool on the other side, showing that they can withstand the pressure. I think that the mistake was on the very early days, as I think that any expert like Nick will have told them, don't do that, because in a few days it's just going to look differently.
Yeah, and then I have a question here from Melanie Brusseler. Do you have any thoughts about how the commodity inflation will shape the kind of European mobilization in terms of stuff that you've been talking about, Nick, in terms of like the managing of demand, and then also the decarbonization push? Do you see a sort of a coherent response coming out of Europe? Do you see the commodity spikes sort of frustrating this attempt at a sort of wartime mobilization to deal with this commodity shock?
Yeah, I think that's really the big political economy question now. It's really reopened this debate over common debt that seemed for a moment at least to have been put to peace or put to rest in the spring of 2020, after there was, the Next Generation EU big stimulus package that the EU agreed on, in many ways a historic moment, but it did kick certain cans down the road. And I think we're now in a situation where clearly there's compensatory policy needed again, and a big rift emerging between northern countries that want to, in a sense, wage this economic war on a laissez-faire basis. And then France, and particularly kind of the southern member states, the Iberian Peninsula, that I think have already been intervening with things like excess profits taxes, and also state support for energy prices for households. And in the case of France, also moving in directly to the nuclear energy sector again with the state. They're much more comfortable with a certain degree of emergency interventionism. The other thing right now is that, there's a big amount of pressure being leveled on Germany, obviously, to agree to an oil and gas embargo. And it seems that the one thing that is not being sufficiently taken into account is just it's being assumed that Germany will not have any major make-or response that can help it offset the damage done by that. So these debates about estimates, I think there's something a little artificial about them as well. Because there's as we know, when you have these sorts of shocks against complex economies, there is a large degree of slack in economies. There's fungibility of resources, even if the elasticity of substitution is a little bit higher than zero. There's already an ability to cushion this shock. So that should mean that Europe actually might suffer somewhat less damage than some of the doomsayers predict as a result of an oil and gas embargo. The flip side of that, I think, is also, by the way, that on the Russian side, Russia also is more resilient against cut-off of certain crucial high-tech exports than people might assume. But I think for Europe, the big question is indeed, is this going to be a fiscal union is there going to be momentum for fiscal union? That seems right now to be kind of buried, but it's a question that's going to keep posing itself, particularly now that it seems the kind of monetary and fiscal global picture is lining Europe up for a pretty hard landing this year. So, then it's also going to be caught up with rule of law questions in Poland and Hungary, right? Next Generation EU almost failed over Polish and Hungarian internal politics. So it's a total minefield. But yeah, I think that's really what I'm focusing on a lot right now, seeing where there's opportunities for moving forward on fiscal union, which I think is very necessary in the long run.
And I just want to throw it now to our conference room folks who are just on the other side of the wall from me. Do we have any questions from the in-person gang?
Yeah. I have a quick question, I guess, more towards Javier. It's a colleague, Jill Wiseman, here in New York. How much of the tightness in commodities even prior to the war, would you say it could have been attributable to, say, ESG climate concerns? Tons of debate about that. Some people was like, oh, there's the poor growth and there wasn't much capital deepening because there was so, the growth post-great financial crisis was so slow. Others talk about the vilification of fossil fuels, et cetera. Like, how much weight should we put to that or think about that aspect of the question?
That is a very important question. And I will struggle to put a percentage, but I do think that it was playing a role in different markets and in different ways. But it's true that a lot of the lack of investment in the oil industry was not just due to ESG, but the fact that we have a period of relatively low prices, not only because of COVID, but since 2015, oil prices, with the exception of 2018, have been relatively weak. The returns also of the money invested in that industry has been quite appalling. I mean, it's very interesting that the US enjoy relatively low or quite low energy prices for many years, all the way up to COVID, thanks to the shale revolution. That had huge macroeconomic benefits to the economy. It was low prices and a lot of investment into capital formation, but the returns of that investment in that capital was relatively poor and investors were losing. So that was the main driver, one of the main reasons that people were not investing. But let me just put the example of coal. Coal prices have been relatively high for a number of years already. There has been no investment in new coal production. Demand for coal, thermal coal, actually hit an all-time high very recently. The consumption of coal into the power sector worldwide hit an all-time high in 2021. And despite that, despite a very tight market, despite very strong demand, and despite very high prices, no one was investing in coal. And if you were to phone any of the big major American banks or European banks and say, would you finance, please, this coal project that I'm doing in, say, Colombia? There will not be a single bank which will provide you credit for a coal mine. So ESG has had an impact. Does it have the huge impact that some people say is all about ESG? No, I don't think that is true, but it is one of the impacts. And even today, the very slow response of the global oil industry, not just the US shale industry, but globally to high prices, is in part dictated by ESG. The signaling was not there. And also, it's just not shareholders and ESG. I mean, a lot of the narrative until about yesterday was we are reducing demand for, we are already reducing demand for fossil fuels, and we are going to reduce that demand further. The reality was very different, but that was the narrative. The narrative for many governments was, this is what we are going to do. Despite that narrative, 2022 will be a record year for oil demand, gas demand, and coal demand, barring a global recession, which I think that I agree with Nick, the risk of that has increased markedly. I don't want to sound like one of these investment bank analysts who, when they want to put a risk and they want to signal a risk, they say something between 5 and 40%. But I think that forgive me for using that range. I do think that at some point we're going to have an economic slowdown, and it kind of reminds me of some of the periods where we have an economic slowdown just after the summer. I think that we will go enjoy our summer holidays and we'll come back in September and we'll see, wow, inflation is very high, industrial production is slowing down, we have a problem.
And sorry, is there another hand in the conference room?
Yeah, I wonder, so I guess this is a question on kind of developing markets. I guess the kind of fashionable view is that the dollar survived this, dollar dominance survives this crisis, but maybe Nick, could you talk a bit about how this changes the politics of how dollar hegemony is viewed, and then like in other words, even if no one seriously starts holding euros or renminbi in their accounts, whether this creates kind of resentment, whether the dollar is seen as a kind of politicized tool, and then if the US and the West were really serious about addressing the emerging markets crisis, which it doesn't especially seem to be, but if there were a willingness to do that, where would it start? You mentioned income supports. What would taking the emerging markets crisis seriously during a period of hiking mean?
Yeah, so on the first question of dollar dominance, so I guess it's useful to unbundle what we mean by that, right? And there's reserve currency status. I think the skeptics are totally right. Nothing's going to happen to the US dollar. But there are some other areas, particularly trade invoicing, where I do think analysts like at the IMF are correct that there is a gentle move away. And it's not massive. It won't mean that the dollar won't remain first among equals. It will, however, mean that there will be parts of the world economy that will now proceed on a more bilateral clearing basis. I think upshot of all of that is that the real limitation on all-out economic war, whether now or by the West in the future against other countries, the real limitation on that isn't technical capacity. I think this crisis has shown that, right? You can freeze the reserves, you can kick banks from SWIFT. The real limitation is politics. And that's, I think, the significance of large countries with large populations like India taking these decisions. You create a 1.4 billion people obstacle to secondary sanctions. So I think the politics of this, and again in Europe, right, the limit on how far they can go is politics. It's burden sharing, it's fiscal logjam, and the inability of northern states to agree to fiscal union. So I think that is really the interesting place to look. I agree, though, that reserve currency status is not really in danger at all at the moment. And on the income support, I mean, I guess here too, right, there are people who watch emerging markets much more closely than I do, who've come up with good proposals, everything from better terms on debt to also thinking. I read a really great piece by Alden Young and David Cadet in Noema Mag just recently on how to think about actually incorporating emerging markets and developing countries into the green energy transition, right? Moving very quickly away from fossil fuels also should incorporate some sort of viable growth model for them. So I think that is a big challenge. I don't have any good answers, but I'll be happy to think more about that in the future.
Do you have any other questions from the conference room?
If I may.
Yeah, sure.
I had a question. So commodities are fungible, but not like fully fungible. I mean, oil can go specific places. You can't quickly rearrange everything. And so one of the things seems to have been and relatedly, part of the cost of the commodity isn't necessarily just the production, but it's the shipping component as well. So something I've been curious about is, say in a world where global governments could fully cushion all the shipping and logistics side of commodities, how much of a shortfall would there be? So I guess phrased otherwise, how much of the shortfall is actually due to not enough production, in which case you'd have to ramp up production, which would take time, and how much of it would be about making the rearrangement of global commodity flows as cheap as possible, as quick as possible, so you could bring prices presumably down faster?
Well, it very much depends of the size of the shock and how much of the production of the export flow of Russia we were to lose. But let's use oil because it gives us a neat example where the numbers are relatively easy to put together. Russia, give or take, exports 8 million barrels a day of crude oil on a market of 100 million barrels of crude oil. I mean, it's 5 million is crude oil, actually 3 million is refined products. If you can rearrange all the shipping and you have no problems with insurance, which right now is the biggest problem. I mean, hiring a vessel today to get a tanker of crude oil out of the Black Sea into Italy will cost you $3.5 million. Insuring that vessel will cost you $5 million. Which is completely mind-blowing. It will be like, that the cost of insuring a rental car was about twice the cost of actually, renting the car. But if we can just forget about every logistic problems, 8 million barrels on a market of 100 million is a lot of oil that you need to replace. Let's say that it's only half of that. Let's say that we only lose 4 million barrels a day of Russian oil. Still, how you do that? And you could ask Saudi Arabia and the United Arab Emirates to increase production, say you will get an extra 1 million barrels a day from them. You could release the strategic petroleum reserves, which is something that we are doing already, but that just gives you about 1 million barrels a day. And you could say that perhaps you are pricing out a bunch of emerging markets and you are doing some changes on the way that we consume oil that will reduce demand for another 1 million barrels a day, which I think is quite generous. But to say that we are all driving less aggressively. We are just sticking to the limit or maybe under the limit, et cetera, et cetera. Okay, you have replaced 3 million barrels a day. But in this very generous case, you are still missing 1 million barrels a day of demand. And the market needs to balance. Supply and demand plus minus inventories have to balance at all time. So you will draw inventories a bit lower, but we entered the crisis already with very low inventories. So at some point, you are going to need to force prices higher. I mean, the market will just put prices higher so to destroy more demand, to get balance. And at the moment, one thing that really concerns me is that governments in developed countries are doing the opposite of what the moment calls for. We should be trying to let the market work and support poor families that they are really struggling. But I don't need a tax handout from the government myself. Other people might need it. But at the moment, we are seeing in Europe and in the US, a tax holiday on fuels, credit cards or debit cards sent to every owner of a car for compensated for gasoline prices. So we keep gasoline consumption higher than they should be otherwise. So makes the substitution and the rebalancing of the market and make it more difficult. But don't be mistaken, the size of Russia in global commodity markets is such that it's very difficult to replace. I mean, we create a hole that just force demand to come down. There is just no way to do it without demand coming down. Somehow, we just need to bring it down. And then the question, as Nick was saying, is burden sharing, who gets what and when and at what price?
I just wanted to take it back to the Zoom questions because we had a few coming in. I think we have some sort of related questions from Tim Sahay and Claudia Som, basically about the effect of financialization and of these commodity markets. And Tim asks, post crash, the Dodd-Frank agenda to reform commodities markets and derivatives was stalled, even as bank regulations mostly succeeded. And how can we avoid having financial speculation and sort of OTC derivatives exacerbate the volatility in the markets that in commodities markets that we've seen in the past couple months?
I don't think that financial speculation, yes, there are moments and the nickel crisis shows that there are times where financial flows and financial positioning because of margin calls play a big role, but that is a bit of a one-off situation. But if you look at the market right now, I don't think that financial flows are really behind what the prices that we're paying. Indeed, the aggregate open interest, that's the amount of outstanding contracts for Brent crude, which is the main oil benchmark here in Europe, is at its lowest in almost 7 years. So actually, we are having the less financial speculation in oil in Europe since 2015. And if you look at some markets, some commodity markets that have seen huge price spikes, what really very concerning to me are ones that they have very little play by financial speculators. I'm thinking about fertilizers, where it's really a physical market, very, very little financial speculation there. Still, again, a market where, you could hedge, but very limited amount of financial speculation on the steel market. Prices are an all-time high. And coal, one of the most unsexy commodities, very little financial speculation, very few hedge funds playing any role in that market, and prices are an all-time high. So while I do think that at times financial speculators can exacerbate some of the trends, really this time is the supply and demand and the risk premia associated with the fact that, how do you price the risk that overnight Europe can lose 40% of its supply of gas? And that really puts a risk premium to the market, which is, yes, financial speculation, but it's also the physicality of the market and the fact that, seriously, in the next, it could happen right now as I'm speaking, just Putin needs to give the order and Gazprom shuts down production and Europe loses 40% of the gas supply. And in 3 days later, there are blackouts here.
Right. Let's see what else we have here. Yeah, I think relatedly, we have Lawrence Peterson asks, I've still not heard a satisfactory answer to the question about Germany's extremely rapid, severe volte-face on energy supply from Russia and the taking on of onerous defense obligations. I still don't understand how some of these moves are remotely logistically possible. So do you Nick and Javier, do you see these kind of big promises coming out of European capitals as matching up with physical reality?
I can say it's one thing about it, which is that definitely the ramp up in German defense spending is big compared to the last 20 or 30 years. But some people say that this is the biggest move since World War II, and that's really clearly not the case, because West Germany in the Cold War had defense spending that averaged 3 to 4% in certain moments of crisis, acute crisis in the Cold War, over 4% of GDP. It was one of the most highly militarized states in NATO. So there is actually a legacy and a memory of high German defense spending. It's just really after 1990, after reunification and the fall of the wall, that Germany really took the peace dividend. So it's on the span of 30 years. This is big, but this is not by any means a kind of real burden for the German economy to bear, to bring it up to 2%. And even this defense fund is going to be a fund that will be there, but it is a question whether this commitment will even last more than 5 or 10 years, right? It's an emergency fund. It hasn't been fully made permanent yet. So I think that it should be placed in some historical perspective, which makes it still a big move compared to recent history, but not as much in the bigger, longer run.
On commodities, Germany is going to have to invest a lot if they want to shift around from reliance on Russian gas. That is something that goes much deeper than just since 1990, because East Germany obviously was wired into the Soviet Union energy supply system for the Eastern Bloc. Western Germany has also in some ways been very happy to have that relationship, and that over the last 30 years, one of the strengths of the heavy energy-intensive industry of Germany has been his cheap access of energy. I mean, Russian gas was for the mighty chemical industry of Germany what the Permian is to the Houston chemical and petrochemical corridor, a cheap source of energy. That was the competitive edge. And Germany is only starting, but this is a very early process. We are only on day, sadly, I have lost the count. I think we are around 45, 47 days of the war. Give it time to Germany. They will make the investment, et cetera, et cetera. But this is not something that Germany can just do overnight.
Let's see what else we have here. Anusar Faruqi, also known as Policy Tensor, asks, would love to know if either of you have thoughts on the Zoltan Pozsar commodities China note that got a lot of attention in the past few weeks, and if either of you want to weigh in on that.
I can jump on it. I mean, I very much agree with Zoltan that my book should be read by everyone, as he put on one of his notes. But sorry, jokes aside. Look, to me, one of the most important things is how, this kind of sector of commodities and commodity traders that everyone has taken for granted ever, no one really care about it, is one of those. It's almost like some of those money markets and short-term credit markets that no one really pay attention until 2008. It's the plumbing of the global financial market that no one really was taking care of. It was taken more or less for granted. It was always there. It was. No one really needs to worry about it. Things more sexy like equity markets, Wall Street, et cetera, et cetera. All of a sudden that stops working, and then everyone pays attention. The commodity trading is very much similar. It's there. It was always there. It was working. You don't need to care about it. It's the plumbing of global trade and global economy that was taken for granted. And all of a sudden we are going to have to really pay attention. But I mean, Consultant, one of the points that he makes is that this is a crisis that you cannot resolve printing money. As 2008, and that's the big difference. And to me, what I will say is, and to me, the most concerning point of the crisis is food. I mean, there is simply no way that you could create more food. And burden sharing on food supplies is going to be very difficult. But we are going to face a huge deficit for wheat markets. And I really don't know what the answer is there. But we are going to see wheat prices being very high, and we may see food riots again. At the moment, rice markets are stable, prices are relatively low, and that's keeping a lot of the food riots from happening. But I think that his main point was that this is a much difficult situation than 2008, because you cannot simply backstop the system printing money. You cannot print commodities, and making the investments to resolve some of the imbalances that we have today. They are not a question of 3 months or 6 months. It's going to take a lot longer. And if the whole world gets to try to resolve these problems at the same time, then we are going to have a tightness on the supply of engineers who can design all these new facilities that we need. And final point that I will make there on burden sharing that Nick touched upon earlier, and that we have yet to see. There's a huge movement right now by Europe, supported by the United States and in part of Japan, to make sure that Europe gets enough LNG. But that is coming in part at the cost of some countries not getting LNG. I mean, Europe can overpay for LNG and outbid everyone else in the world if needed. And at the moment, there are countries that they were supposed to be getting cargoes of LNG, and those cargoes have been diverted and sent it to Europe, but Pakistan is not getting the LNG. Other countries in Asia are not. And that's going to be very problematic. Pakistan is going to have to either burn fuel oil or coal this summer, or they're not going to have enough electricity to make it through the day. So they're going to have rolling blackouts every day of the summer. We're not talking about that, but burden sharing is going to be very important. And that should be something that the G7 and now a completely dysfunctional G20 should be looking at.
Yeah, Nick, do you want to weigh in?
Well, just one thing actually, that just listening to Javier give his very interesting take on Zoltan's note brought to mind is that one of the ironies actually of the situation is that none of the three major hubs of the world economy, the United States, Europe, or China, are themselves dealing with food as a crisis. It's just basically everyone but them. And the weird thing is that historically, right, the United States, but also, for example, Japan and the EU have all had these big agricultural support programs and subsidies. For decades, they were decried as violations of market logic, incredibly inefficient. The British really hated them, and they were blatantly there for political purposes, right? They were put in place after World War II as one of the earliest stepping stones in Europe, particularly to prevent the countryside from going for fascism, as it had done in the 1930s. The irony of that is that now there are many problems, many commodity-related problems, but at least for the developed economies, food isn't one of them. And there is actually a food self-sufficiency. But yeah, I still think, like Javier said, there's a lot of other questions out there. And it seems merely that raises the problem of burden sharing at a different level.
Yeah, I guess, that reminded me, there's been some amount of debate over, is there a food crisis? Can the rest of the globe make up the difference? Like Australian farmers, for instance, are probably going to do a lot of planting to in response to the price hikes. But yeah, I mean, how can those countries, that are under the most pressure, in particular, like the Middle East and North Africa, from the loss of Ukrainian wheat, like, what kind of, what do they have to do to get through the next few months? And is there any evidence that there's a global effort to help them coordinate that response?
Yeah, no, very little so far. And I think that it's really quite country specific, and it depends very much on trade structure. So I did a little bit of work on the 2010-2011 commodity price shock, and it's linked to the Arab Spring and the way in which also the aftermath of the global financial crisis was a driver of that whole process. What's really striking is that if you looked at North Africa and the countries and the Middle East, the countries that had the Arab Spring, it was the countries that were most vulnerable were those that were large-scale commodity fuel and food importers, but that had no offsetting commodity exports. So Algeria, for example, very much a food importer, but also has very large gas and oil exports. So the budgetary effect on the Algerian state was neutral. They did have protests, but the government was able to keep them under control. Tunisia and Egypt, very large importers, but have no offsetting major commodity exports. So there, and also in Syria, this really bit. That's actually an interesting thing, because the last few years, for example, one of the countries in Africa that people are very concerned about is Nigeria, the fastest growing population in the world. But Nigeria too, as a commodity exporter and also even an LNG producer, is benefiting here. So it has a very specific pattern, which on the one hand is good because it means that there doesn't have to be necessarily money given in the same degree to everyone, or that it's as acute everywhere. It's quite specific. So I think if we start to use some of those criteria, we can kind of find out which countries are at the most severe risk of getting into trouble. And then I really think, again, it's the income and the demand side response. There's a really strong argument for having that finally in these middle and low income countries, not in the advanced economies where the supply side bottleneck solving should, I think, take priority.
And then I just want to ask, do we have any more questions from the conference room? No. All right, I think that's pretty much it. Well, one more from our own Hala Ahmed. Do you think that the kind of the fiscal supports following COVID, does that maybe exhaust the appetite for the developed economies to make those kinds of outlays for foreign aid and to do the income supports that we're talking about? You know, have we kind of like, you know, already eaten our fiscal seed corn a little bit?
It could be very well. I mean, I think that as I said at the beginning, the commodity market arrived to this crisis already under stress, because we were facing shortages even before Russia started the invasion of Ukraine. Perhaps the fiscal side is also under stress because we have had to deal with COVID, and it's going to be also very complex, the response of central banks, having missed the inflation wave. Now they may over tighten, and I mean, tightening monetary policy is not going to resolve any of the commodity bottlenecks that we have at the moment, and it could really central banks may kill inflation, but they may kill the economy in the process. So yeah, I worry that there will be two areas in particular that they will going to suffer. One is just going to be, you know, the appetite for more support for low-income families. Everyone kind of was hoping that after COVID, the budgets were going to come down, that, you know, all this fiscal spending was going to be able to be reduced. And I think that we're going to struggle with that, because the poorest sectors of our society are going to continue needing support to deal with very high food prices and very high fuel prices, even in advanced countries. But then the other one is going to be what is going to be foreign aid. I mean, I follow very closely the 2007 and 8 and then 10-11 food crisis. And one of the biggest shock to me was when the World Food Program, which is this fantastic program from the United Nations to support really areas that they're facing immense hunger, they just literally ran out of money. They just could not buy any more food. And their budget went from something like about $800 million a year, which is all from donor countries, to about $5 billion in the space of about 18 months. And the WFP is going to suffer something similar to that. And I don't know if there's going to be the appetite from the European Union, Japan, the US, Saudi Arabia, some of the largest donors of the WFP, to really put again that kind of money. And that's going to be a big challenge, because food is one of the things that really worries me, because we learned in 2007, 8, and then 10, 11, as Nick was mentioning, the Arab Spring, that food security go with political stability really hand in hand.
Yeah. Well, on that upbeat note, I think we can wrap up. But Nick and Javier, thank you so much for joining us today. I thought this was a really fascinating conversation. And thanks so much for our attendees for joining us. I had a lot of fun. I was glad that we had a good turnout. I also want to remind everybody that if you've registered for this event, you have some discount codes for Nick and Javier's book. I've read them both in the past couple of weeks. They're fantastic. This has been a really great conversation. Thanks again for joining us.
Thank you.
Thank you.
All right.
Bye.
Thanks. Bye-bye.